Greetings and salutations, test takers. This is Dean Tinney coming to you from my studio here in fabulous Las Vegas with episode 5 of our SIE exam podcast. We're doing it in terms of weighting. Section 2 has 33 questions on understanding products and their risks. And the last thing we want to be talking about before we move on to another section of the SIE is mutual funds. The better term is probably packaged products. Packaged products would include in this category things like REITs, partnerships, ETFs, ETNs, that kind of thing. So, one of the things you're heavily tested on is being able to contrast an open-end fund with a closed-end fund. And I always tell you that you really want to overlearn on your SIE exam these topics. Because if you're moving on to a Series 7, again, you'll be tormented with the difference between open-end and closed-end funds, and that'll be on your 65 and your 66 as well. So open-end funds are continually offering new shares to the public. And since an open-end fund is continually offering new shares to the public, not only is it going to have to comply with the Investment Company Act of 1940, it's also going to have to comply with the Prospectus or Paper Act. 33 says if you're selling brand new securities, that's what open funds are doing to the public. That's what they're doing. You have to make a registration statement. Now, again, primary transactions are transactions which the issuer is receiving the proceeds, and open-end funds are, again, those are primary transactions. And when you're done, want to go home in an open-end fund, you redeem. So, there's no secondary market. There's no secondary trading. Whereas a closed-end fund does typically an IPO, initial public offering, and then those shares are going to trade supply and demand. For example, the Mexico fund is a closed-end fund, MXF. It trades on the New York Stock Exchange. The Mexican market is very volatile, and if you're a Mexico fund shareholder and you can't handle that volatility, we simply tell you to sell your shares to someone else for more than or less than you originally paid. So that's the major distinction. There are others. We're trying to get these podcast episodes in about 30 minutes, but that is the big testable difference. Now, in the open-end fund, we're going to have the NAV plus the sales charge equals the public offering price, right? And so let's talk a little bit about the different loads in a mutual fund as well as the different share classes. So, we have share classes. We have A shares. A shares are the traditional shares of an open-end mutual fund. Back in the day when I was a baby broker, retail broker, I started as a retail broker, ended up as an institutional broker. But when I was retail, I sold a lot of the Franklin funds, for example. In the Franklin funds, the A shares had a front-end load of 4%. And the test question on A shares in terms of suitability is an A share is good for somebody who has a large sum to invest at a long-term time horizon. And that makes sense because we're going to be talking about quantity discounts. And if you have a larger amount to invest, maybe you'll qualify for that quantity discount, that break point. A B share is going to be suitable for somebody who has a smaller amount to invest, but has a long-term horizon. B shares have what's called a contingent deferred sales charge. And, the fund will say in a B share, assuming the fund offers it, a lot of mutual funds are going back to just having A shares because all these different share classes can be confusing to brokers and customers. But, typically I say the mutual fund would say, if you stay in 5 to 7 years, we'll waive that sales charge and we'll turn your B shares into A shares. Again, question is 2 points. Make sure you don't misuse no load terminology. A contingent deferred sales charge is still a sales charge. A B share is certainly not a no-load fund. And then the second point, again, is suitability for a smaller amount to invest and a long-term horizon. The C shares are typically have an expense, a promotional expense that doesn't go away. Maybe it's we'll just make up a number, 0.75%. And, if I'm paying 0.75%, maybe in that 5th or 6th year, I should have just paid the 4%, been done with it, than paying that forever and ever and ever. So the C share suitability is going to be somebody who has a small, shorter time horizon, right? Because at some point that promotional expense will eat up, there'll be a crossover where you would have been better to go into a B share and have it waived over a certain length of time, or even an A share and pay the load and be done with it. We have no load funds. A no load fund is NAV plus sales charge equals pop. That's the same for an open-end fund, but NAV here plus sales charge is going to be zero. Now, if a no load fund wants to have a promotional expense, they certainly can do so. And a no load fund can charge up to, test question, 0.25% and still refer to themselves or hold themselves out to the public as a no load fund. If you go past that, you can no longer refer to your fund as a no load fund, right? So that would be the max for a 12B1 fee. If you want to start your own mutual fund, I don't know why you would. There are more mutual funds than there are Taco Bells. There are actually more mutual funds than there are securities to put into them. But if you were going to start your own mutual fund, you would need to comply with the Investment Company Act of 1940. And the Investment Company Act of 1940 says you're going to have to classify yourself as either a face amount certificate company. Who cares? We don't care about that at all. A unit investment trust. We do care about that. Fixed portfolio, passive management, or a management investment company, either opened or closed. And if we want to start our own mutual fund, we need $100,000. I think that's ridiculously low, by the way, and 100 shareholders. We could probably start our own mutual fund with just the folks and resources we have on this call. We're recording this live, by the way. So if you are putting things in chat or making comments, I will take care of that after we finish up the episode. Net asset value under the Investment Company Act must be calculated at least once per business day. And very testable to know that we're always doing business based on the next calculation of the NAV. So you say, hey, Dean, I'm going to invest $50,000. How many shares am I going to get? I said, well, I don't know, until we send your check off to the mutual fund sponsor, distributor, underwriter. They cash your check. They do the next calculation of the NAV. You say, Dean, I'm redeeming my shares. How much money am I going to get? I say, I don't know, because it's based on the next calculation of the NAV. That process is very testable, and that process is called forward pricing. The idea that we're always doing business based on the next calculation of the NAV. And again, that is very, very testable. We have breakpoints. Breakpoints, very testable, are quantity discounts. And boy, RTFQ, a quantity discount is a good thing. I always think of, Costco. I go, man, I don't need 2 tons of salsa, but it's so cheap, right? You're getting a discount because you're buying in bulk, you're buying in volume. And so a mutual fund would have a breakpoint. I'll use what I used to have as a retail broker. I don't know if this is still true, but back in the day when I was selling mutual funds, and lots of them, Franklin would have a breakpoint at $100,000. If you invest $100,000 or more, the sales charge goes from 4% to 3%. But that's a wonderful thing, right? So I should tell you about this quantity discount. You say, well, Dean, how much should I invest? I say, well, you ought to invest $99,999. And you say, why? I say, well, because if I get you for $99,999, I'll make $4,000. And to give me another buck, I'm only going to make $3,000. So be really careful what you're being asked on your exam. A breakpoint is a wonderful thing. It's a quantity discount. A breakpoint sale is a bad thing. That's when I try and maximize my commission by avoiding that breakpoint. And the easiest way to make sure I stay out of trouble with that is to tell you all of the ways you can get the breakpoint. So let's say in my example, we're doing this as a podcast. I will link in the video description and in a pinned comment to the full lecture on mutual funds package products for you. And I highly recommend, no surprise, you watch that full lecture rather than listening to this podcast episode. But that being said, the easiest way to stay out of trouble is to tell you how you can get the best deal. I said, well, listen, you think within the next 13 months. So, I'll use Franklin again. You say, Dean, I'm going to put $80,000 into the Franklin tax-free fund. I said, what do you think over the next 13 months, you might be able to come up with an additional 20 grand? Because if so, we should fill out a letter of intent. Very testable. A letter of intent is good for 13 months. You say, well, Dean, there's no chance I'm coming up with the additional 20 grand, so I'm not filling out the letter of intent. I go, okay, well, that's fine. I mean, I understand. And then you call me and say, damn, Dean, I should have filled it out. I just came into some money. I said, well, good news. The letter of intent can be backdated 90 days. That 90 days is inclusive of the 13 months. So if we wait 90 days, we've got 10 months left to actually get that letter of intent done. All right, so the maximum sales charge we can charge on a mutual fund is 8.5%. That too is testable. I told you that as we classify ourselves as to type, one type of investment that we have in the Investment Company Act of 1940 is a unit investment trust. The test question here is it's a fixed portfolio of professionally selected assets. Fixed portfolio. It's not being actively managed. So, if you don't like these securities in this portfolio, you shouldn't buy proportionate ownership or units in it because they're not going anywhere. Very popular with, bonds, for example. And as the bonds pay the semi-annual interest that gets passed through as the bonds get called or the bonds mature, that too gets passed through the UIT holders. And what you need to know is, again, fixed portfolio, passive management, not active management is what that means. And that means lower cost structure and perhaps more tax efficiency. Don't tell your compliance office I said this because they'll be very disappointed in me and maybe never refer you to the channel again. But I think of a variable annuity as a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. In a variable annuity, what we're doing is taking the money and putting it instead of the insurance company's general account, putting it in a separate account, a mutual fund. And you're not going to be able to get constructive receipt of that. A regular mutual fund, whether or not you take the distributions of capital gains and dividends. A lot of mutual funds have what are called dividend reinvestment programs. And I say, I don't need the money, so just buy me additional fund shares. As far as the IRS is concerned, you could have got that money and that's the same as getting it. And you owe taxes on it. That's called constructive receipt. The test point is not that. The test point is in variable annuities, they make me reinvest into the separate account. And therefore, I'm not getting constructive receipt. And therefore, the money is growing tax deferred. And that's why we refer to a variable annuity as a non-qualified retirement plan. Non-qualified meaning you're funded with after-tax money. You're going to have a cost basis. Cost basis is simply the fancy word for when you turn your money into an investment. And it's going to grow tax deferred, and at 59.5, you can withdraw that. Now, to sell a variable annuity, you not only have to be registered to sell securities, you also have to have a registration to sell life insurance. You're going to have to be duly registered to sell a variable annuity. You need to be able on the test to contrast an exchange-traded fund with a traditional open-end mutual fund. There are some things that people don't like about open-end mutual funds. One of the things, test point, that people don't like about open-end funds is this idea of forward pricing. The idea you're always doing business based on the next calculation of the NAV. Contrasting test point. ETFs trade real-time supply and demand. There is no forward pricing. Another thing people don't like about open-end mutual funds is you cannot purchase them on margin. Reg T, set by the Federal Reserve Board, says that new issues are considered ineligible for margin. You have to pay in full. It's considered new issue 30 days from the issuance. And so that means you can't buy open-end mutual funds on margin because, again, it's a new issue. ETFs, testable point, can be purchased on margin, right? So real-time pricing, supply and demand, you can buy them on margin. For test purposes, they're passively managed. And what comes from being passively managed is, again, a lower cost structure. There is a problem with paying monkeys to harvest bananas. And, the problem is they eat the product. And the single largest expense to a mutual fund is the investment advisor. Be careful what I said, RTFQ, read the full question, read the full answer set. I didn't say what is the single largest expense to a customer. That's the sales charge. I said to the fund. That's the investment advisory fee. So if it's passively managed, that means there's going to be a lower fee structure to the ETF. And if it's passively managed, it's going to be more tax efficient because mutual funds, when the fund manager sells, it could be a capital gains distribution. We wouldn't expect that in an ETF. And so ETFs have a lower cost structure, and therefore they're more tax efficient, as well as, again, having less fees. So you have to be able to contrast an ETF with an open-end fund. And the other thing you got to be able to do is contrast an ETF with an ETN. When in an exchange traded fund, we are making an equity investment. An equity investment. What we're buying is, proportion ownership in the exchange traded fund. And I guess it could go to zero if all the securities that are in the ETF go to zero, but it's an equity investment. Exchange traded fund. Exchange traded notes. Keyword is a note. The contrasting testable point is that exchange traded notes, unlike ETFs, which are an equity investment, ETNs are a debt instrument. And that means, like any other debt instrument, you have credit risk, the risk of default. Now, again, what this is where the sponsor agrees to pay you based on some base rate. I'm oversimplifying, but that's my job. Let's say the referenced index is the S&P 500. It's a $100,000 exchange traded note. The S&P goes up 20%. The sponsor, distributor, financial institution owes you 120 grand. And you have the risk that they may or may not be able to pay you. That's much different than making an investment in an ETF. Now, I would have no problem, I guess. I mean, I probably would still, but probably not buying an ETN or worried about credit risk if it's JP Morgan or, Wells Fargo or BlackRock or, Bank of America or Schwab or Vanguard. But, if the ETN's coming from, I don't know, Dean Savings and Trust, I might have an issue with that. Okay, so you buy a REIT for the same reason you would buy a mutual fund. You buy mutual funds for professional management, diversification, and ease of ownership. And you buy a REIT for the same reason: professional management, diversification, ease of ownership. The distinction is that you're buying a professionally managed portfolio of securities when you buy a mutual fund. And when you buy a REIT, you're buying a professionally managed portfolio of real estate. And, both mutual funds and REITs are going to pass through at least 90% of their net investment income. Please note, they don't flow through losses. They flow through income to the mutual fund shareholders or the REIT holders. The IRS has been kind enough to say that if they do that, they'll wait and tax the fund shareholder rather than taxing the fund. Most funds do much, much better than that, because why keep any of it if you're going to have to pay taxes on it? But that 90% is called the conduit or pipeline theory that's being passed through. Now, when we're offering a real estate investment trust, they can be offered as private placements. So whether the private placement is for unregistered stock, or whether the private placement is for unregistered units in a partnership, or whether it's a unregistered or private placement, in this case of a REIT. You should definitely know that when we're offering securities, whatever those securities may be, in this case a REIT, privately, what that means is we're using an exempt transaction under 33. And the exempt transaction we're using when selling private or unregistered securities is what's called Reg D. And for me to allow you to participate in a private placement, you would have to be an accredited investor. And again, the definition of accreditation is also very testable. And the accreditation standards, if you want to buy a REIT on a private placement basis, is going to be $1 million in net worth, exclusive of your primary residence. And so, I want to send you an invitation to invest in whether it's a hedge fund, private equity fund, venture capital fund, or whether in this case it's a REIT, or whether it's, the ground floor opportunity and to buy unregistered securities and SpaceX. You have to have $1 million net worth exclusive of your primary residence. And you say, well, Dean, I don't have that. I said, well, okay, well, hold on. I have another one. You don't have $1 million in net worth exclusive of your primary residence. Do you make $200,000 for the last 2 years with the expectation of 200,000 this year? You say no. I say, are you married and filing jointly? You make $300,000 for the last 2 years with the expectation of that this year. Now a good way to remember this is $1 million net worth exclusive primary residence. 2, $200,000 in annual income for the last 2 years with the expectation of that this year. 3, $300,000 of annual income, married and filing jointly for the last 2 years with the expectation of that this year. A good way to remember it is 1, 2, 3. So whether, again, we're using this to sell you a private REIT or a registered REIT, registered unlisted means it can be sold to the public. So registered securities can be sold to the public. Unlisted means it doesn't trade on New York or NASDAQ. So registered means, again, we've registered under 33, because remember what 33 says. If you're going to sell brand new securities to the public, like a REIT or stock or whatever it is, mutual fund, you're going to have to make a registration statement. And then unlisted means it doesn't trade, which means it's going to be illiquid. And then listed are the ones that do trade like a stock. And this is a good way to get an asset allocation to real estate in a liquid form. So one listed REIT, I don't own it any longer, but I owned it for many years, is called Boston Properties. Boston Properties is a REIT, trades BXP on the New York Stock Exchange. And what you are buying is a professionally managed portfolio of commercial real estate. I know you're not going to be surprised in Boston, New York, San Francisco. So that would be why you would buy a REIT. And this pooled investments that we're doing in today's episode of our podcast series for the SIE, we have other pooled investments besides mutual funds, besides UITs, ETFs, ETNs, and REITs. We also have hedge funds, private equity funds, and venture capital funds. And these are all sold on a private placement basis again. These are sold using Reg D. And so, these are organized as private partnerships. The hedge fund manager, the private equity fund manager, the venture capital fund are what we call the general partner. And then the investors in these funds are limited partners. And again, to be a limited partner in one of these funds, and since they're done under Reg D, you're going to have to, again, be accredited. And the one thing the hedge fund doesn't do is hedge, but, hedge funds are purposely trying to avoid having to be mutual funds because there's all kinds of constraints when managing money under the Investment Company Act of 1940. And a hedge fund doesn't have any of those restrictions. They can use options, they can use derivatives, they can use commodities. They are allowed to pursue very aggressive investment strategies that mutual funds are not. Private equity funds, again, what they typically do is go find opportunities to make investments either privately, take public companies private, and then take them public again. And then venture capital funds invest very early in the stage of a company, life stage. We also have direct participation programs. And direct participation programs, the key word is direct. You're making a direct investment into real estate, into oil and gas, whatever the case may be. And this business structure, again, has a general partner and it has limited partners. General partners provide the management. Limited partners provide the investment capital. And these have a flow through of both income and losses. So, for example, the Warriors are a partnership. And so the Warriors have no retained earnings. Whatever their profits or losses are, they flow through to the limited partners. All right. So let's see. We have anything else here to talk about in this episode? Oh, yeah. One more thing we need to talk about. The Municipal Securities Rulemaking Board has determined in their infinite wisdom that 529s, local government investment pools, and able accounts are municipal securities. And if they say they're municipal securities, well, then they're municipal securities. 529s are used to finance a college education. Here in Nevada, where I'm coming to you from, our state 529 plan, that's sponsored by the state of Nevada, is managed by Vanguard. And, I can put up to 15 grand times 75 grand in this pool portfolio, and Vanguard manages it. And then I'm hoping when the kid reaches the age where they're going to need to draw down on that, they would have those resources available. I don't know of anybody anymore who offers Coverdales because the 529s are just so much more advantageous. If you get a question about a 529 in the SIE, my guess it's going to be a comparison about 529s versus Coverdale IRAs, and they just blow them out of the water. I mean, for example, Coverdale's $2,000. I mean, how much college education can you get for $2,000? A local government investment pool is the equivalent of a money market fund for local governments. So, the city and county school district may pool their resources on their short-term cash so they can buy money market instruments and get a little bit of return, like negotiable jumbo CDs, commercial paper, bankers' acceptances, T-bills, things like that. And again, if the MSRB says it's a municipal security, it's a municipal security. It's a municipal equivalent of a money market fund. And again, these would all require some type of disclosure document to be able to offer them. The ABLE accounts are for people who become disabled. The only question here is the disability has to have onset before age 26. And so that 26 is an aim and shoot point and click test question. All right. So I hope you found this episode helpful. Our next episode will be in a different category of the SIE exam. Remember, inch by inch, your SIE exam is a cinch. Yard by yard, your SIE exam is hard. And we'll be posting the next scheduled episode at some point in the future. I am now going to check the chat and see if I can answer any questions you may have as it relates to the SIE. If you joined us for something else, I'll answer those questions. Hi, Dean, just stopping by past the 63 DA. All right, Stewie, woohoo. Yeah, I do a whole series, Stewie, of your exam, your series in 60 minutes. So I'm glad you found that helpful. Kind of weird that you're doing the 66. That's kind of weird because usually the 63, the follow-up would be a 65. Stewie, I just want to make sure that you don't have a 6, because if you're doing 663, the 66 will do you no good. The 66 isn't operational unless you have a 7. Starting the study for the SIE, then 65 or 66, 726. Well, here's my recommendation for you. I would highly recommend that you don't go for limited registrations. And a 26 is a limited registration. It only allows you to supervise people selling mutual funds. So I would bite the bullet. I would go SIE 766 and hold on, 24. Be a general securities principal. I'd rather be a general securities principal than a limited principal. Here's the, I don't want to put up negative vibes, but I can't tell you how many people, take a 6 and eventually got to take a 7, or take a 26 and eventually have to take a 24 because things change. So there you go. Oh, I like it. I like it. I was told about your YouTube channel. Thank you so much. I do think on the SIE, there are people who use my channel as their primary studies source and do indeed pass the SIE and use their paid study materials as a supplement. So that's not the first time I've heard that. I'm not willing to claim that my channel alone will get you through the exams, but this will be our third playlist for the SIE. We have the playlist number 1 is SIE lectures, and they're in suggested watch order. And in that I have where I go through the content outline provided by FINRA and explicate that. I highly recommend those first 4 or 5 videos of that playlist. I have a whole nother SIE playlist that just includes practice tests and practice questions. And this will be our third SIE playlist. It's a podcast series as I'm working my way through the exam. So we'll have a total of 3 there. So whoo! So I'm glad to hear that. Thank whoever referred you to the channel. I love referrals. So tell them thank you very much on my behalf. Yeah, I think I would start with playlist number 1. The playlist likely videos are in suggested watch order, and I would start working my way through that playlist. Hey, Ivy, how are you, my friend? Ivy is, we got to come up, Ivy, with a way to distinguish our regulars, our supporters, from people who are the newbies, if you will. Right. So Ivy has been a loyal supporter of the channel, and always good to have our alumni. I don't know, Ivy, if I call you alumna popping in. So just past the 6. There you go. You're welcome. It's my pleasure. It's always very gratifying when the channel can make a contribution to testing victories. I think that's what's made the channel so successful. We're coming up on 3 million views. We're coming up on 25,000 subscribers. Just amazing. And again, I don't engage in search engine optimization. I don't ask you to like or subscribe or, so, I hope that we help you pass the test, and then you tell your friends. And that's old fashioned, I know, but that's kind of the game plan. Will you be posting episode 6 soon? The answer is yes. My game plan, the reason I'm doing these live is it's just a nudge to me. So I probably could have a more polished podcast episode if I recorded them first and then, did retakes. I'm just not doing that. I'm just putting them up and I'm letting it fly. So that means, Jasleen, the answer is yes. You could expect the next episode next week sometime. And I'm trying to keep to that weekly schedule. Tonight, I got a little later start than I had planned on because I just, I got busy. So if the free stuff always takes a back seat to people who are willing to pay for things. So any suggestions for a young man who wants to start a career in finance? Well, yeah, I get jealous sometimes. I'm an old man, but I got to tell you, I love that part of our channel. I meet young men and women who are coming into our industry, and if you're poor and deserve to be rich, then this is the industry for you. And I've had many young men and women who I just think are in such an ideal kind of a place to start their careers. So my suggestion and recommendation is to get first things done first, which is passing your exam. Now, if you don't have sponsorship, you remember you can take the SIE without sponsorship, and that's a way to show some initiative when you go to get your first paying job. I would also say that early in the career, now some people disagree with me and have taken my advice and later regretted it, but it worked for me. So what can I tell you? If I were starting my career, I would be more interested in a learning experience or learning environment than I would actually pay. I mean, obviously, if I can get a good pay, but I would just say that's not actually would be, I hope, the determinant factor. Hopefully your offers, if you get a job, are in there. But I have two things. One, a job is better than no job. So any job I can get in finance that puts me on my, my career, I'm going to take it. Now, given that I have more options than that, maybe I don't. But if I do, then I'd be looking for where is the best opportunity for me to learn the business. And that's why I'm kind of with some of the old school guys like Jamie Dimon and James Gorman and, Brian Moynihan, where, we are losing the idea of coming into the office to learn, because it's kind of hard to learn if you're, we're not all on Zoom or something. So that's what I'd be looking for, a good supportive environment. And then hopefully you can work with people you like, because you're going to be spending more time with people in the office, perhaps, or in our industry than you are with your family in some days. And so my rule was I'd never hire somebody I didn't want to spend the day with. Right. So, I'm like, listen, it's not a match. It's not a match. You're welcome. You're welcome. All right. Anything else that you might want to put in the chat before we end this episode? And again, be looking for next week's episode. I think we'll be in section 2. As I said, we're doing this in reverse order of waiting on the SIE exam itself. So that's the plan. We're doing it live. And sometimes if I cut or edit the chats that take place afterwards on these live episodes, sometimes I leave them up. Just depends. Okay, well, if nothing else, remember, once again, inch by inch, your SIE is a cinch. Yard by yard, your SIE is hard. And I will see you next time for our next episode. Bye-bye.